Today, we're going to be talking about individual stock returns versus investing in the index, and specifically concentrated positions. And I really consider a concentrated position to be anything that makes up 25% or more of your investable assets. So let's start by picturing a normal distribution curve. So think back to your statistics class in college or high school, where you have that curve that has a nice peak in the middle. So you might expect that that is what individual stock returns look like. In reality, individual stock returns is a story of extremes. We actually don't see that nice smooth curve with most returns being average. We actually see a significant chunk of individual stocks being underperformers and significant portion being overachievers. Now, this is from a study that looked at over 14,000 stocks, US stocks that existed during this period of time, and we're looking at their lifetime returns. And so if you are investing in one company, you actually have a very significant risk of picking an underperformer, and that means a stock that has a greater than negative 75% lifetime return. Granted, you might also knock it out of the park and pick one of those stocks that has significantly better returns than an index, say the S&P 500, but the range of returns is very different, and that is the risk that you take when you hold a concentrated position. And we actually know that 44% of those individual stocks lost money over their lifetime. So if you just randomly pick a stock during that period and put all of your money into that investment, you had a 44% chance of actually losing money, which is pretty significant. That's a big risk to take if you are investing in individual stocks. Owning a concentrated position in a large company does not necessarily reduce the risk of a significant loss. We have plenty of examples we could talk about, but this is just a short list of companies that experience significant gains, a ton of record new highs, and then at some point, a very significant loss from their peak. And we're talking 80 to potentially 99%. So, sometimes we get this feeling that as our company continues to rise and that stock price continues to hit new highs, that there's nothing that could devastate those returns that we've experienced. But it's really not worth taking the risk that a position that's earned you a lot of wealth up until this point could potentially be reduced 90% tomorrow, especially if you are working at the company that you are receiving stock, whether that's stock grants or ESPP shares. Your human capital is also tied up in that company. So if something goes wrong and there's a significant hit to the stock price, well, you might also be losing your job. And I also like to remind people, if you are currently receiving stock in your company, well, you're going to continue probably to receive it in the future if you work there. So selling a current position is less consequential because you'll continue to have exposure to that company in the future if that's what you so desire. Well, what about taxes? I hear this as one of the top reasons that people tell me they don't want to diversify out of a position. Well, let's be honest about taxes, because if you have a significant amount of unrealized capital gains in a stock position, it means that you've hit a home run. And as we saw in previous slides, almost half of individual stocks actually have negative lifetime returns, with only 1 of 5 having those kind of extreme positive returns. So it is not worth the risk that you are going to be holding a company that ends up with a negative return at the end of its lifetime if you're already sitting in a position where you have significant gains. So it is well worth the taxes that you pay now to diversify and put those proceeds in a index fund or a mutual fund that provides broad-based stock exposure. Now, you want to be careful about the type of gain you're recognizing. Short-term capital gains are usually taxed at higher rates, and that's for any investment that is sold that you've held for less than a year. If you've held that stock for more than a year, you qualify for long-term capital gains status, which is usually a more favorable tax rate. So I want to emphasize again, diversification over concentration. Yes, there is a chance your position may be one of those extreme winners and you may knock it out of the park, but those odds are not in your favor. So especially if you have had positive returns in the past and your position now makes up a large portion of your portfolio, lock those gains in, put those proceeds in a diversified portfolio where you can more consistently expect positive returns over the long run. That's it for today. I'd love to hear feedback. Please comment below and let me know any questions you have for future videos.